But look, clearly the story of the hour is NVIDIA's power over the markets and how to invest up to it and through it. So let's get right to the floor show here. Two of the best guys to help you tackle it from both the micro and macro picture. JP Morgan Asset Management's global market strategist, Jack Manley, and Carnivore Trading's Dutch Masters. I don't know, Dutch, I guess you could go back to Apple because for a while Apple held the market's reins. But can you remember anything similar to NVIDIA's spell that it holds over the markets right now?
Oh, I'm sure there have been some, but boy, I'll tell you, this is unbelievable, really.
Yeah, and so what do you do in that case? Is it? I have a lot of people on my TikTok because I talked about it on TikTok today, and they said, "Oh, you got to buy puts," because if NVIDIA meets estimates, that's not good news for the markets. It's horrible if it disappoints. But even if it beats, if it doesn't beat by that whisper number, which is always pumped up with names like this that are momentum plays, you still have a problem, don't you?
Yeah, you do. I think the expectations are really, really high. Now, the way we look at it is that the big market cap, big cap tech stocks have had a hell of a run. And it's really time for them to pause a bit. And we've seen companies come in with good earnings. You know, your Palo Alto had good earnings. They met estimates. They beat estimates. But, you know, their guidance was a little light and not good. We're seeing a lot of that happening out there. And so it really doesn't matter what NVIDIA says right now. They're going to be fine. They're going to say they're firing on all cylinders, that their business is, you know, shooting up, and they've got plenty of demand and lots of backlog. But we don't see that being a driver in the market going forward. We're going to need to see some broadening in the market. We've had to move out of that big cap tech. We had a good run with biotech stocks, and now we're moving really into some kind of weird stuff like marine transport stocks and some aerospace defense stocks.
Because they're beaten down?
No, they're actually making money. I mean, you know, this is where they are. I mean, we've had a hell of a run with these cybersecurity stocks, Liz. I mean, and now they are just getting crushed. And, you know, it's been 3 years that these stocks have been leading and pumping and pumping and pumping. And so now we've got a little bit of a pullback there. We're seeing half of the home builders miss their earnings and half of them make their earnings. So we like the oil and gas tankers like TK. We like AVAV and HWM for in the aerospace area. And frankly, the solar space is a disaster, and we're shorting it.
Okay, you're shorting that. Let me get to the guy who's the global market strategist at JP Morgan. Jack, when you get to the whole team at JP Morgan and they're hanging on your every word about what's our strategy, is it all U.S., especially considering that you have the names like NVIDIA as best in class, Microsoft, et cetera?
Liz, I will tell you, cards on the table, I have forever been a U.S. bull. That's just the way I think about things. And when you look at how the equity market has just shifted over the last couple of decades, the U.S. has become increasingly technology dominated, tech and tech adjacent names. And that is very clearly the way of the future, right? No one is going to look at you and tell you seriously that technology is going to be less important in 10 years. And now artificial intelligence is this new thing that we're all excited about. It was the internet before. It was, of course, the computing age before that. And nobody does it better than the U.S. does. And so I think if you are a long-term investor, there is a lot to be said for overweighting the U.S. relative to the rest of the world. But where we stand right now, with valuations so elevated, with the recovery having been so concentrated up until this point, we are thinking about some opportunities outside of the States. It's just about how you reframe that conversation. Luxury goods in Europe, biotech in Europe. I don't want to talk about valuations. I don't want to talk about the next 6 to 12 months. I want to talk about the next 5, 10, 15 years, the secular trends that are emerging in those regions. They're going to help to shape their economies, shape their equity markets. That's how I stay excited if I'm a longer-term investor in that space.
Okay, and as you talk about how dominating the U.S. technology space has become, they've done it where rates were much higher than they had been over the past couple of years because the Fed raised rates to try and quell inflation. We got the Fed minutes at 2 p.m. Eastern, just about an hour ago. And in essence, what you saw with those minutes was that there is a very big sort of jittery aspect to many of the voters who say, we don't want to cut rates too early if inflation hasn't been slayed. Is that the appropriate way to take things?
I think that is the right way to think about this conversation about interest rates. I mean, mean, you look at some of the data that we've gotten out over the last even 3 weeks, you are talking about CPI that came in hotter than expected, PPI that came in hotter than expected. That was kind of a double whammy last week. We had an extraordinarily strong employment report, unemployment rate at 3.7%, job gains north of 300,000, continued strength in wage growth. All of these things, I think, are concerning for the Federal Reserve, and they are particularly concerning given what you said, Liz, which is that everybody seems to just be able to shrug off the impact of these higher interest rates, that higher interest rates actually aren't doing a whole lot to slow down the economy. But the important thing to remember here is that back in December, when the Fed released its most recent summary of economic projections, that dot plot that we pay a lot of attention to, they told us 75 basis points of cuts this year. It was the market that was looking for 125, 150, 175. So we're just kind of getting right back to what the Fed initially had been telling us that we should have been listening to all along.
I don't even think it's going to be 3 cuts. It may be 2, possibly 1, because you see inflation so sticky. We're actually going to talk about that coming up with Jared Bernstein of the White House. He's the chief economic head there. And so we got to ask him about that. But in the meantime, Dutch, when you look at inflation and the better opportunities for stocks that do well in a sticky inflation environment or a disinflationary environment where inflation at least is slowing, what are they? What are the sectors that you say, you know what, that one will hold up?
Well, like I said, I think that, you got to go where the money's flowing, and we're flowing into the tankers and we're flowing into some of the aerospace and defense stocks, but because that's where the money's really going. They're going to drop rates, and I totally agree with your guest there, because honest to God, this is, we all were looking for maybe 75 bips. The market got way out ahead of itself, and it's not going to happen probably till June, and maybe even after that. But they will drop rates, and that'll probably be good for the market overall. But we really want to see the Russell 2000 start to percolate, and it's not going to probably happen until then. So we're kind of in no man's land until June, I think.
Jack, Dutch, thank you very much. We're looking at the Dow down.